This is Cece. Welcome to the Orbit. It is Monday, April 15th. We've got stocks basically flat. We're up about 0.25% right now. We were up much more on the open. Stocks opened higher, a little bit of a relief rally on the open from the red day we saw on Friday. Of course, that was a lot of traders and investors nervous going into the weekend with everything going on in the Middle East. There was a little bit of a relief rally this morning, but it has since faded. And now we are looking at a situation where we've got higher vol that has remained over the weekend, not quite as high as Friday, but it has remained, and a little bit of uncertainty in the market remains. There's some put buying still going on, and definitely a different backdrop than we've been seeing the last few months. So let's dive into it. We're looking at the 1 week chart in SPX, and we have about a 1.4% expected move. That is 17.5 IV. You can see that up in the upper right corner. This morning on that rally, we saw vol compress a little bit, and we saw that number actually get closer to 15 or 16. But then with this little bit of weakness, and we got down to basically about unchanged on the day, that put a little bit of fear back into the market. On the 1 day chart, we can see about an expected move of just under 0.5%. That's been pretty consistent all day. It was higher coming into the day, a bigger expected move. But that is 26 IV on the day. We saw on Friday that get up to about 35. And of course, everybody saw what the VIX did on Friday. And so from an expected move standpoint, about 0.5% for the rest of the day. That let's go in to see what that looks like. That's the short put on the 51.15 side and the short call on the 51.60 side, and that gives you about that risking 300 to make 200. If we expand that a little bit and give ourselves a little bit room on the short strikes, about 51.75 to the upside and 5100 to the downside, we get closer to that 4-to-1 risk ratio. Going out to the week, and we will pick Friday, April 19th here on the selector, spin that up. We've got 52.10 on the short call side and 50.70 on the short put side. That is about 60 points in either direction. And you can see where that takes us on, if we take this on the 1 month chart, to sort of give you a sense of that 52.10 level. You can see it's not quite those highs that we saw over the last couple of weeks, but taking this and expanding this a little bit. Let's go to where we get at least the short put on the 50-50 side and that short call at that 52.30 side. You see this about 350 to 150 risk reward ratio at the bottom. And if we took it even farther and got that top strike up to that 52.50 level, we are 52.50 on the upside, 50.30 on the downside, and that is that 4-to-1 risk ratio. So that is SPX, and of course, we've been trading at around these levels. We haven't quite gotten to 5100 or below it the last few days, but a lot of traders will have that level in mind if there is a test of that level and what the response to that test is. And then, of course, those highs, those recent highs, are quite obvious on the chart. Legging in and out based upon weakness and strength. Obviously, if you use that strength this morning to sell call spreads, credit call spreads, either today or out a couple of days or to Friday, that would have turned out to be so far a good level to get that kind of premium off. If we saw a test of 5100, perhaps that's a chance. Again, that expected move is 60 points in the other direction. If we saw a move down to 5100, that would probably expand to 70 points or even 75 points in either direction. And perhaps that's an opportunity to get some credit put spreads off, short duration, of course, down closer to that, even closer to the 5,000 level. And of course, if the market goes down, volatility will pick up. If the market goes higher, volatility compresses a little bit, but as we've seen this morning, it is not compressing back to an all clear symbol. We are likely to see an elevated VIX for some time. There's a lot going on. There's, everybody's got their eye on yields. Everybody's got their eye on oil. Just checking in. Let's look at USO to get a sense of what oil's doing today. So the oil play is not necessarily the thing hurting the market and stalling that rally today. But when we go into TLT, this is, longer term yields. A lot of people have, compressed their view as to what they're looking at. The 1-year yields, the 2-year yields, the 10-year is what a lot of people are focused on right now. But we've got TLT down, right? And that is putting pressure on the market, is that we are still seeing expectations, investor expectations and trader expectations keep pushing out the potential for the Fed lowering rates. And of course, that is putting pressure on stocks. And there's no better spot to look at the pressure of rising yields and then IWM. We've now got IWM down to 197.50 on the 1-month chart. You can see it sort of rolling over here. And then on that 3-month chart, you can see where we are. And so this market probably does not rally significantly until that pressure of those yields comes off the market and comes off stocks. And IWM is a perfect spot to watch that play out.